Are you letting your money sleep in the bank? Now that's a question many of us don't often ponder. It's common practice to leave our hard-earned cash nestled in savings accounts, thinking it's the safest place for it. The comforting clink of coins, the crisp rustle of banknotes, we associate these with security and peace of mind, right? Well, here's a wake-up call. Traditional banks offer interest rates that are, let's say, less than impressive. We're talking about a measly 1% or even less. Meanwhile, the silent beast of inflation is ever lurking, eating away at the value of your saved money over time. What does this mean for you? Simply put, your money is losing its purchasing power while it's dozing off in the bank. It's like a never-ending game of chase where you're always one step behind. So, is there a better way to manage your money? Let's explore. You are welcome to Smart Wealth Guide, where we guide you on the path to financial wisdom and a wealthy tomorrow. Consider this: what if you had invested your money instead? Let's imagine two friends, John and Sarah. 10 years ago, they both received an inheritance of £20,000. John decided to play it safe and keep his money in a traditional bank account. Sarah, on the other hand, chose to invest her money. Fast forward to today. John's £20,000 sat in his bank account, slowly accumulating a modest amount of interest. Over 10 years, let's say his money grew at a rate of 2% per annum. By the end of this period, he has a little over £24,000. Not bad, right? Now let's turn our attention to Sarah. She invested her £20,000 in a diversified portfolio, achieving an average annual return of 7%. At the end of the same 10-year period, Sarah's portfolio has grown to nearly £40,000. That's almost twice as much as John's. But it doesn't end there. Remember, Sarah's money is still invested and continues to grow, while John's money is still sitting in the bank, barely keeping up with inflation. The gap between their financial outcomes will only continue to widen as the years roll by. This simple example illustrates the power of investment. By choosing to invest, Sarah has allowed her money to work for her, creating wealth over time. On the other hand, John's decision to leave his money in the bank has resulted in a much smaller return on his initial £20,000. Now, it's important to remember that investing involves risks, and it's not guaranteed to always produce higher returns. But as Sarah's example shows, over a longer time horizon, investing can potentially yield significantly better results than leaving your money in a traditional bank account. Clearly, letting your money work for you can make a significant difference. So don't let your money sleep in a bank account. Wake it up, put it to work, and watch as it grows over time. Ever heard of the term compound interest? If not, prepare to have your mind blown. You see, compound interest is a bit like magic. It's the principle where you earn interest not only on your initial investment, but also on the interest you've already earned. Imagine a snowball rolling down a hill. As it rolls, it collects more snow, growing larger and faster. That's compound interest in action. Let's paint a simple picture. Suppose you invest £1,000 with an annual interest rate of 5%. At the end of the first year, you'll have £1,050. But the magic happens in the second year. You'll earn interest not only on the initial £1,000, but also on the £50 you earned in interest. This process repeats year after year, and over time your money can grow significantly. As you can see, your money can grow exponentially through compound interest. But what about the risks involved in investing? That's a question we often hear. It's true, investing does come with risks. It's not a game of chance, but a calculated risk-taking venture. But don't let that scare you away. Just as in life, the financial world also abides by the principle: no risk, no reward. Investments can fluctuate, markets can take dives, and economic downturns can happen. But remember, risk is inherent in almost every aspect of life. Even leaving your money in a bank involves a risk. The risk of your money losing its value due to inflation. So how can we manage these risks? One of the most effective strategies is diversification. It's a bit like not putting all your eggs in one basket. By spreading your investments across a variety of assets, stocks, bonds, real estate, or even commodities, you reduce the likelihood of a single event wiping out all your investments. Another strategy is to adopt a long-term investment approach. Markets may be volatile in the short term, but historically, they've trended upwards over the long haul. By staying patient and not panicking during market downturns, you give your investments a chance to recover and grow. It's also crucial to make informed decisions when investing. Don't just follow the crowd or the latest trends. Do your own research, understand what you're investing in, and make sure it aligns with your financial goals and risk tolerance. Risk is a part of the investing journey, but with knowledge, strategy, and patience, it can be managed effectively. And remember, the prospect of growing your wealth and achieving financial independence makes taking calculated risks worthwhile. Investing might seem like a high-wire balancing act, but with the right knowledge and approach, you can navigate it with confidence. It's all about understanding the risks, managing them effectively, and making informed decisions. Knowing how to balance risk and reward can make investing a lot less scary. And remember, the journey to financial independence starts with a single step. So, are you ready to take yours? So, where else can you put your money, apart from a traditional bank account? Let's dive into some alternative investment options that could potentially offer higher returns. First off, we have stocks. When you buy a company's stock, you're buying a piece of that company, you become a shareholder, and if the company does well, you stand to make a profit. However, stocks can be volatile, and there's always a risk that the company's value may go down. Next up, bonds. Bonds are essentially loans you give to a company or a government. In return, you receive interest payments over a fixed period and your initial investment back at the end of that period. Bonds are generally considered safer than stocks, but the trade-off is usually lower returns. Then we have mutual funds. These are pools of money from many investors, managed by a professional who invests in a diversified portfolio of stocks, bonds, and other assets. The benefit here is that you get diversification and professional management, but you also have to pay fees for these services. Real estate is another option. This could mean buying a property to rent out or investing in a real estate investment trust, which operates like a mutual fund for real estate. The potential returns can be high, but so can the initial investment and the ongoing costs. Last but not least, there's peer-to-peer lending. This is where you lend money to individuals or small businesses through online platforms in return for interest payments. It's a relatively new form of investing, and while it can offer high returns, it also carries its own set of risks. Remember, each of these options carries its own set of risks and rewards. It's important to diversify your investments to spread the risk and potentially increase your returns. Remember, the best investment option for you depends on your personal financial goals and risk tolerance. So do your research, consult with a financial advisor if needed, and make informed decisions about where to put your money. Now that you know the alternatives, what's next? Well, it all comes down to this: taking charge of your financial future. You see, your money is a tool, and just like any tool, it's only as effective as the person wielding it. Having a grasp on financial education is not just about knowing the alternatives to a traditional bank account. It's about understanding the economic landscape, staying informed about investment trends, and seizing opportunities as they arise. It's about making informed decisions that will help you build a strong and secure financial future. Imagine you're a captain of a ship. You wouldn't set sail without a compass, a map, and a good understanding of the current weather conditions, would you? Similarly, navigating the seas of finance requires knowledge, a plan, and an awareness of the current financial climate. Financial education is your compass, guiding you towards wise decisions. Your financial goals are your map, providing you with a clear destination. And staying informed about investment trends and opportunities? That's like understanding the weather conditions. It helps you avoid stormy waters and capitalize on favorable winds. So how do you stay informed? Well, there's a wealth of information out there: books, online articles, podcasts, YouTube channels like this one, financial advisors. All these resources are at your disposal. Use them to broaden your financial knowledge and keep up to date with the latest investment trends and opportunities. Remember, your financial future doesn't just happen. It's created, shaped by the decisions you make today. Don't let your money lie dormant in a bank account, slowly being eroded by inflation. Make it work for you, invest it, grow it, and let it become your ticket to financial freedom. Your financial future is in your hands. Don't just let your money sleep in the bank, make it work for you. Subscribe for more financial insights and tips. Your journey towards financial independence begins now. Thank you for watching. Please like, share, and subscribe for Smart Wealth Guide.